You're 3 months into retirement, and you just realized you made a mistake with your 401k rollover. A mistake that's going to cost you $28,000 in unnecessary taxes. The financial advisor who helped you retire never mentioned this timing issue. Now you're sitting there wondering what else you don't know. What other landmines are waiting in decisions you haven't even realized you need to make yet? That knot in your stomach? That's what we're going to untangle today. Most retirement advice focuses on what you should do. But after spending over 2 decades in investment banking and portfolio strategy, I've learned something more valuable: what you absolutely need to avoid. The mistakes that cost retirees the most aren't usually about missing opportunities. They're about stepping on financial landmines that were completely avoidable. My name is David Harrington. I spent over 2 decades as an investment banking analyst and portfolio strategist, navigating market cycles, recessions, and financial bubbles. After stepping away from institutional finance, I now focus on helping everyday people, especially those approaching or enjoying retirement, understand money in a calm, practical way. Before we continue, a quick note. This isn't financial advice. Everyone's situation is different. Think of this as education to help you ask better questions and make calmer decisions. By the end of this video, you'll know the 5 most expensive mistakes retirees make in their first 5 years, and more importantly, how to avoid every single one of them. These aren't theoretical problems. These are the mistakes I watched people make repeatedly, mistakes that cost them tens of thousands of dollars and years of unnecessary stress. If this kind of practical retirement guidance is valuable to you, please subscribe and hit the like button. It helps this information reach more people who need it. Let me start with the mistake that costs retirees more money than any other, and it happens in the first 90 days of retirement. You leave your job. Your HR department hands you paperwork about your 401k. You have 60 days to decide what to do with it. Most people roll it over to an IRA without thinking twice. Seems straightforward, right? And for most people, it is the right move. But here's what almost nobody tells you. If you retire in the year you turn 55 or older, your 401k has a special feature that disappears the moment you roll it into an IRA. It's called the Rule of 55, and losing access to it can cost you 10% of every dollar you need before age 59 and a half. Let me make this concrete. You retire at 57. You roll your $600,000 into an IRA like everyone told you to do. 2 years later, you need $50,000 for an unexpected medical procedure not fully covered by insurance. You're 59, so you're still under 59 and a half. That withdrawal triggers a $5,000 penalty on top of the taxes you already owe. But if you'd left that money in your 401k, you could have taken it out penalty-free because you retired after 55. Nobody mentions this because it only applies to certain situations. If you don't think you'll need the money before 59 and a half, rolling over makes perfect sense. But if there's any chance you might need access to that money in those years, keeping it in the 401k gives you flexibility you can't get back. Here's what makes this mistake so painful. It's irreversible. Once you roll that 401k into an IRA, you can't put it back. You've lost that early access feature forever. And you made that decision in your first 60 days of retirement when you were barely thinking clearly about anything except the fact that you don't have to set an alarm anymore. This connects to something else that catches people off guard in those first months. You retire in January. Your income drops dramatically. You think you're in a lower tax bracket now, so you decide this is the perfect year to do a Roth conversion. You convert $80,000 from your traditional IRA to a Roth, figuring you'll pay taxes at your new lower rate. Smart move, right? Then December rolls around. Your former employer sends you a 1099 for the $40,000 bonus you earned last year, but didn't receive until February. Your investment account sends you a 1099 for the $15,000 capital gain distribution you didn't ask for. Suddenly you're not in the 12% bracket like you thought. You're in the 24% bracket, and that Roth conversion just cost you an extra $9,600 in taxes you didn't plan for. I've watched this scenario play out more times than I can count. People make major tax decisions in January based on what they think their income will be, then get surprised by income that shows up later in the year. Deferred compensation, final bonuses, severance payments, capital gain distributions, all of it counts as income even though you didn't control the timing. The smarter approach? Wait until November or December of your first retirement year, to make any major tax moves. By then, you know what your actual income looks like. You can see all the pieces on the board. You're making decisions with complete information instead of guessing in January. Think about it this way. You wouldn't file your taxes in January before you received all your forms. Why would you make irreversible tax decisions before you know what your tax situation actually is? Now here's something that happens in year 2 or 3, and it's subtle enough that most people don't realize they're making a mistake until it's too late. You're living on your retirement income, Social Security, maybe a pension, some withdrawals from your IRA. Money's a little tight, but you're managing. Then your roof needs replacing. $18,000. Your emergency fund can cover it, but you think to yourself, why drain my cash when I have all this money in my IRA? So you take $18,000 out of your IRA to pay for the roof. You pay the taxes, it's done, and you feel good about keeping your emergency fund intact. But here's what just happened that you might not have noticed. That $18,000 IRA withdrawal increased your adjusted gross income by $18,000. That higher income just pushed you into the next Medicare premium bracket. Your Medicare Part B premium is going up by $1,200 next year, and the year after that, and the year after that. You pay for that roof repair 3 times over, and you'll keep paying for it until your income drops back down. This is called an IRMA surcharge, income-related monthly adjustment amount. Medicare looks at your income from 2 years ago to determine what you pay in premiums. One large withdrawal can trigger higher premiums for years. And most people have no idea this is coming until they get the notice from Social Security. The better move? Use your emergency fund for the roof. It's exactly what emergency money is for. Then gradually rebuild that fund over the next year or 2 with smaller, planned withdrawals that keep your income below the IRMA thresholds. It takes longer, but it saves you thousands in premium increases. What makes this particularly frustrating is that the IRMA thresholds aren't that high. For 2024, if you're single and your income exceeds $103,000, you start paying more. For married couples, it's $206,000. A single large withdrawal for a legitimate expense can push you over that line without you realizing the long-term cost. Let me shift to something that seems responsible, but often backfires in retirement. You spent your whole working life hearing that debt is bad. So when you retire, you decide to pay off your mortgage. You've got $140,000 left on the house. You take it out of your IRA, pay off the loan, and now you own your home free and clear. Feels incredible, doesn't it? Except here's what you just did. You triggered $140,000 of taxable income in 1 year. Let's say you're married, and that pushed you from the 12% bracket into the 22% bracket. You just paid $14,000 more in taxes than you needed to. Plus, you triggered IRMA surcharges on your Medicare premiums for the next 2 years. Plus, you depleted $140,000 from your retirement account that could have stayed invested and growing. Oh, and that mortgage you paid off. It was probably at 3% or 4% interest, and the interest was tax deductible. You were essentially borrowing money at 2.5% after the tax deduction to keep $140,000 invested that was likely earning 6 to 8% over time. You traded a favorable financial arrangement for the emotional satisfaction of being debt-free. Now, I'm not saying paying off your mortgage is always wrong. If that monthly payment was causing you genuine stress, if you were lying awake at night worrying about it, the peace of mind might be worth the financial cost. But most people don't run the numbers before making this decision. They just assume debt-free is always better. The smarter approach? If you want to pay off the mortgage, do it over several years. Pay an extra $2,000 or $3,000 a month from your taxable accounts. You'll own the house free and clear in 4 or 5 years without triggering a massive tax bill and without depleting your retirement accounts all at once. Here's what this really comes down to. In retirement, cash flow matters more than net worth. Having zero debt, but no liquid money is more stressful than having a small mortgage and plenty of accessible cash. The monthly payment is manageable. Being house rich and cash poor creates the kind of stress that makes retirement miserable. This connects to a broader mistake I see constantly, and it's one that financial advisors don't always catch. You retire with most of your money in traditional IRAs. Your taxable brokerage account is relatively small. You figure you'll live off the taxable account first and let the IRA keep growing. That's what you've heard you're supposed to do. delay taking money from tax-deferred accounts as long as possible. So you spend down your taxable account over the first 5 or 6 years of retirement. Then you hit your early 70s and required minimum distributions kick in. Suddenly you're forced to take out large amounts from your IRA, whether you need the money or not. Your income spikes. Your taxes jump. You're in a higher bracket than you ever were while working. And you're paying higher Medicare premiums because of the forced withdrawals. Meanwhile, if you've been taking moderate amounts from your IRA throughout your 60s, filling up the lower tax brackets each year, you would have paid far less in total taxes over your retirement. You could have even done strategic Roth conversions in those lower income years. But now it's too late. You're stuck with mandatory distributions at the worst possible tax rates. This is what tax professionals call a tax torpedo. You try to be smart by deferring taxes, but you accidentally build a tax bomb that explodes in your 70s. I watched this happen to a colleague's father. He retired at 62 with $800,000 in his IRA, lived off his pension and Social Security for 10 years. Then RMDs hit at 73. His forced withdrawals pushed him into a higher tax bracket than he'd been in while working. He paid more in taxes in 5 years of retirement than he would have if he'd been taking strategic withdrawals all along. Here's the principle that ties all of these mistakes together. Retirement is not the accumulation phase with a different number. It's a completely different financial game with different rules, different risks, and different optimal strategies. What worked brilliantly while you were earning a paycheck can be exactly wrong when you're living off your savings. During your working years, minimizing taxes this year made sense. You were in a high bracket. Deferring income was smart. But in retirement, you might be in the lowest tax bracket you'll ever see again. Deferring taxes from a 12% bracket today into a 24% bracket 10 years from now isn't tax planning. It's tax avoidance that costs you more in the long run. During your working years, keeping money invested for maximum growth made sense. You had time. You could ride out volatility. But in retirement, that large one-time withdrawal that triggers penalties and surcharges and higher tax brackets, that can cost you more than any investment growth would have gained you. During your working years, paying off debt aggressively made sense. You were building net worth. But in retirement, cash flow and liquidity matter more than net worth. A paid-off house doesn't help when you need $20,000 for an unexpected medical bill. Let me give you one more mistake that's less about money and more about psychology, but it costs people just as much. You retire, and everyone tells you to meet with a financial advisor. So you do. The advisor looks at your portfolio and says you're too conservative. You've got too much in bonds and cash. You need more growth. You're going to outlive your money if you don't get more aggressive. This advice sounds responsible. It sounds like the advisor is looking out for your long-term security. But here's what's actually happening. That advisor gets paid more when you have more money invested in managed accounts. They get paid more when you're taking risk. They don't get paid on the cash sitting in your savings account or the bonds in your portfolio. I'm not saying all advisors are bad actors. Most genuinely want to help. But the fee structure creates an incentive to push you towards strategies that benefit them as much as they benefit you. And here's the thing. At 68 years old, you don't have 30 years to recover from a market downturn. Being too conservative might mean you have slightly less to leave your kids. Being too aggressive might mean you run out of money while you're still alive. The mistake is letting someone talk you into a risk level that doesn't match your actual situation. If you're lying awake at night worrying about your stock allocation, you're taking too much risk. I don't care what the Monte Carlo simulation says. I don't care what historically has been optimal. Your stress level matters. Your sleep quality matters. Your ability to stick with the plan through a downturn matters more than theoretical maximum returns. During the 2008 financial crisis, I watched retirees panic and sell at the bottom because they couldn't handle the volatility their advisors told them they needed to accept. They turned a temporary decline into a permanent loss. Meanwhile, the retirees who had more conservative portfolios, the ones the advisors called too safe, they slept fine. They didn't panic. They recovered just fine because they never sold. What sounds good on paper versus what actually works in real life for you? Those are two different things. And no financial advisor lives in your body or your brain. They don't feel your stress. They don't lie awake at night when the market drops 15%. You do. Here's what all of these mistakes have in common. They're not about lack of information. They're about timing, context, and understanding how the rules change when you transition from earning money to living off your savings. The 401k rollover mistake. That's about understanding special rules that only apply for a few years. The tax conversion mistake. That's about timing decisions when you have complete information. The IRMA surcharge mistake. That's about understanding how one decision ripples forward for years. The mortgage payoff mistake. That's about recognizing that retirement cash flow is different from pre-retirement wealth building. The RMD tax bomb. That's about understanding that deferring taxes isn't always optimal. The risk tolerance mistake. That's about knowing that financial theory and your lived experience might point to different strategies. None of these are complicated, but they're all easy to miss if you don't know they exist. And once you've made the mistake, it's usually too late to fix it. You can't put money back in a 401k. You can't unconvert a Roth. You can't unborrow money you used to pay off your house. So what do you actually do with this information? First, before you make any major financial decision in your first year of retirement, pause. Run it by someone who understands retirement-specific tax rules. Not just any financial advisor, someone who specializes in retirement distribution strategies. The 401k rollover, the Roth conversion, the mortgage payoff. None of these decisions need to be made in the first 60 days. Take your time. Second, think in terms of cash flow, not just net worth. How much accessible money do you have for unexpected expenses? How much are you forced to take out in taxes and surcharges when you make a large withdrawal? The goal isn't to optimize every dollar. The goal is to maintain financial flexibility while minimizing unnecessary costs. Third, be strategic about tax bracket management throughout retirement. Your 60s might be your lowest income years ever. That's when you want to be taking moderate IRA withdrawals and possibly doing Roth conversions. By the time RMDs hit in your 70s, you want your traditional IRA balance to be smaller than it is now, not larger. Fourth, understand that your risk tolerance isn't what you think you can handle on paper. It's what you can actually handle when your account is down $80,000 and the financial news is talking about recession. If you don't sleep well with your current allocation, change it. You're not trying to beat the market. You're trying to maintain financial security and peace of mind for the next 20 or 30 years. And finally, recognize that the first 5 years of retirement are when you're most vulnerable to costly mistakes. You're learning a new set of rules. You're making decisions you've never had to make before. The stakes are higher because you don't have a paycheck to cover mistakes anymore. Take your time. Ask questions. Get second opinions. And don't let anyone pressure you into strategies that don't feel right for your situation. Your retirement security doesn't come from maximizing every possible dollar. It comes from avoiding the big mistakes that derail people. And now you know what those mistakes are. Your future self, the one who's 75 or 80 years old, still financially secure, still sleeping well. That person is counting on the decisions you make today. Make them carefully. Make them with full information. And make them based on your actual life, not some theoretical optimal strategy that works great until it doesn't. That's what I learned in 2 decades of watching both institutional investors and regular people navigate markets. The ones who did well weren't always the ones who maximized returns. They were the ones who avoided the mistakes that couldn't be undone. Be one of those people.